Well, we're going to talk first Retirement Plan 101. What is a qualified retirement plan and what are the types of qualified retirement plans? Well, let's start at the beginning and clarify that qualified retirement plans, you'll hear the term qualified, refer to Code Section 401A of the Internal Revenue Code. That is distinguished from IRAs. Qualified plans are different than IRAs, so we're not talking about IRAs. We're talking about qualified plans. You'll hear the term qualified sometimes. Then, having said that, there's two major categories of qualified plans: defined benefit plans and defined contribution plans. So then I will define what they are, the differences between the two of them. And then defined contribution plans include 401k, profit sharing. In the old days, we used to have money purchase plans, and they're still sometimes used, not as often. Defined benefit plans are that. Defined benefit plans, also cash balance or target benefit plans. I think the first thing, again, is to contrast IRAs versus qualified plans. IRAs are typically plans for small employers or for individuals. The advantages of IRAs: they have very low administrative costs. There's no tax return due, little testing for IRAs. The disadvantages: the contribution limits are much lower than they are in qualified retirement plans. Qualified retirement plans, you need an administrator. There's a tax return due. There's testing that's due. There's greater flexibility on allocating contributions among participants. And so there's more work, administrative cost for a qualified plan. The advantage is the contribution limits, deduction limits are much, much greater for qualified plans. So what my firm does, we administer qualified plans. We don't deal with IRA plans. Well, the first thing we'd have is a discussion with you as to what your goals and objectives are for a plan. What are you looking to get out of it for you yourself as the business owner? What are you looking to for your employees? What do you hope your employees might get out of the plan if you want them to participate in the plan, which means we'd have a 401k plan. So the first thing we try to do is discuss with you your business goals, what you're thinking of a retirement plan. Part of my job is to educate you on the different types of retirement plans. Defined benefit plans are one class, defined contribution another class. Defined benefit plans typically can have much, much larger contribution amounts. They can be $100 to $150, sometimes $200,000 a year for an individual, for a person. Defined contribution plan, by contrast, is limited to $49,000, $50,000, and 2012 in contribution. So the contribution limits are very different, but there's other significant differences between them. So my job would be to educate you a little bit, give you a little bit of knowledge on defined benefit versus defined contribution. Listening to your goals and objectives, then we make a decision. What kind of plan do we want to focus on? What kind of plans do we want to focus on that might fill your needs? I think the first thing is, three things I think, is the contributions that you as a business owner, what are you looking personally to get out of the plan? Small and medium-sized businesses, the retirement plan is oftentimes still a key part of the business and personal planning, the retirement planning for the individual. Larger corporations, the retirement plan becomes less important for the business owner. So the first thing is, what are you as the business owner hope to get out of the plan for retirement and or current needs and so forth. Second is, how much does the company want to spend on a plan? How much does the company want to contribute to the plan? When I say spend, I don't mean administrative cost. I mean, how much money does the company want to contribute to the plan for yourself and or for the employees and so forth. And there's a big difference between companies that say we'd like to put in $5,000 a year, $50,000 a year, $500,000 a year. That affects the plan design clearly. And the third is, how much involvement do you want your employees to have in the plan? There are plans that the employees have no participation. They don't do anything. They just get company contributions. They get a participant statement at the end of every year, and they're done. There are obviously the more popular 401k plans where the employees have the opportunity to contribute part of their own salary to the plan. And so that's a key component. How much involvement do you want the employees to have, and what kind of population base you have of employees? Education, compensation levels, ages, all of those things we try to glean from you to design a plan that's going to meet your goals and objectives. The retirement plan may advance your business from the standpoint of employee morale more than anything else, I suppose. In this day and age, as you hire employees, that's one of the first things employees are looking for, prospective employees are looking for, is, do you have a retirement plan? What type of retirement plan? So clearly a retirement plan is going to help you attract employees, that's going to help your business grow and prosper and so forth. More to the point, the retirement plan is going to help you as an individual prepare for your retirement. In the marketplace that we're in, the small and medium-sized companies, again, the retirement plan is typically a very significant part of you, the business owner's personal planning. And so we're going to help you set aside as much as you can for retirement. That we'll do it through the company, business deductions to the company. So you're saving taxes today. It's a tax-deferred vehicle. You're saving income taxes today. Someday in the future, when you take money out of the plan, it will be taxable. So it's a tax-deferred vehicle that we're trying to set up a retirement plan for you. Step 3 then is, once we know your goals for a plan personally and for the business, we know we have some idea of what contributions the company might want to make to a retirement plan. Then we do some designs of retirement plan proposals for you. We would come back to you with some 401k illustrations, profit sharing illustrations. We would come back to you with different illustrations to show you how the moving parts come together, show you what you can get out of a retirement plan, show you what the employees can get out of a retirement plan, what the business deduction is going to be, and so forth. So based upon your goals, personal goals, business goals, we would design some proposals to show you that then we can talk about to focus on what kind of plan would be best for your business. The big difference between defined benefit and defined contribution plans. Let's just talk about that for a second. If you wanted to put $100,000 away a year for yourself, then we need to talk about a defined benefit plan. If you want a lower contribution, then we're in defined contribution world. But let me just contrast that for a second. I tell people, think of the terms as defining what the plan is. A defined benefit plan defines the benefit that is going to be paid at retirement. It's going to guarantee that there is a lump sum of money available when you reach retirement age that is going to be payable to you. It defines how much is going to come out of the plan at the end, the benefit that you're going to get. A defined contribution plan, by contrast, defines the contribution that goes into the plan today. Then whatever is there, whatever that accumulates to before you retire, that's what you take out at retirement. Whatever those contributions have grown to be, that's what you take out. There is no guarantee at the end as there is in a defined benefit plan. A defined benefit plan has the advantages of sometimes much, much higher contributions for an individual. As I said earlier, the contributions could be $100,000, $150,000, $200,000 a year for an individual, versus in a defined contribution plan, the maximum would be $50,000 a year. Much higher contributions in a defined benefit plan. A defined benefit plan, however, has a requirement for an actuarial valuation every year that has to be submitted to the Internal Revenue Service, so the administrative costs are a little bit higher for a defined benefit plan than they are for a defined contribution plan. A defined benefit plan, I tell clients, has a required contribution every year. In a defined, let's start with the easy. A defined contribution plan, the employer has complete discretion from year to year on how much to contribute to the plan. Can be nothing one year, can be a substantial number, up to 25% of pay. The next year, anything in between, the employer has complete discretion. A defined benefit plan, because we have guaranteed that there's going to be a pool of money available at the end, we have defined the benefit at the end. A defined benefit plan has the actuary has to determine how much contribution has to be made each year to reach that goal at the end. So a defined benefit plan does not have the same discretion, the same flexibility and contribution amount on an annual basis as a profit sharing plan or defined contribution. So whatever we design in a defined benefit plan, whatever contribution level, is a level that we should be planning on for 2 or 3 years at least, that's the contribution level we're comfortable making. We can always amend a plan, we can always change a plan, but it does not have the same flexibility and contribution amount that a defined contribution plan has. Defined benefit, much larger contributions. Sometimes we lose the flexibility of how much to contribute. The administrative costs are more. Defined contribution plan, much lower contribution limit sometimes, much greater flexibility in how much to participate, how much to contribute, and lower administrative costs. We would then try to listen to you and get your goals for the plan, and then come back with some proposals on plans. Defined contribution plans, there are the simplest types of defined contribution plans are profit sharing plans. Profit sharing plans, all of the money that goes into the plan is employer contributions. The employees do not make contributions to it. It's the simplest to administer. It's the least expensive to administer. It's the most easily understood by employees, and it's the basic plan in many, many businesses. 401k plans are the most popular that we hear about in this day and age, of course. We read about them every day in the newspaper or magazines. 401k plan is a profit sharing plan, but also allows employees to make individual contributions to the plan. They have the option to defer part of their salary into the retirement plan. So in a 401k plan, we may have what I'll call three sources of money. There is the employee money that they elect to contribute to the plan. There may be a company matching contribution where the company is going to match on some basis what the employees have put into the plan. And third, there may be a company profit sharing contribution at the end of the year that above and beyond what the employee has done, above and beyond the match, the company may elect to decide to make a profit sharing contribution, which oftentimes then we are directing as much of that as we can to the business owner, to get as much to the owner as we can. So we have our choice of defined benefit plans, larger contributions, more expensive administration, less flexibility, but much, much larger contributions sometimes, versus defined contribution plans, much more flexibility, lower administrative cost, and lower contribution amounts, however. In the form of business organization that you have, whether you're a C Corp, S Corp, partnership, limited liability company, or a sole proprietorship, you work by yourself as a sole proprietor, the form of business organization does not affect the retirement plan. Any form of business organization can have any of the retirement plans that we've talked about. So the form of business organization is irrelevant for retirement plan purposes. Sub S, C Corp, partnership. The only caveat is in a Sub S corporation, you as the business owner can get compensation in a Sub S corporation either through a W-2 or you can get your K-1 distributive income at the end of the year. For retirement plan purposes in a Sub S corporation, the only thing we can consider is W-2 pay, not the distributive share of K-1 income. Different from partnerships where we use the K-1 income, limited liability companies, etc. But the form of business organization is not important. More important is going to be what dollars that you want the company to put in a retirement plan for you, and second, what dollars you want the company to put in the retirement plan for your employees. And then those are the most important two pieces to start with. Again, the second piece, third piece, is the employee participation. Do we want a 401k plan where the employees can contribute to the plan? That will be important to decide. And if we want the employees to come into the plan, then we want to know, we'll look at the census data that you have. What is the age of your employees? What is the education level of your employees? What is the compensation level of your employees? All of those elements we would take into account in designing a 401k plan for you. The education, the age, compensation levels, all will affect how much the employees may contribute to a plan, which will affect your ability to contribute to a 401k plan. So those are elements that we would take into account when we get ready to design a plan and make a proposal. The only people that should be in the meeting are your decision makers, the business owner, an HR person if you have an HR, controller if you have a controller that you'd like to have in the meeting. Most of the time in the small to medium sized business, we're just going to be dealing with the business owner directly, and that's who's going to be in the meeting. My first meeting is to try to educate you a little bit on the types of retirement plans, defined benefit versus defined contribution, so I can get some feedback from you as to how much contribution you might want to be putting into a plan. Again, if we're talking about you'd like to put away $150,000 for yourself, we're in the defined benefit world. If we're talking about you'd like to put away $30,000 for yourself a year, we're in the defined contribution world. So the first thing we want to do is focus on yourself, how much money you want to contribute to the plan, the company contribute to the plan for yourself, and then we talk about the employee involvement and what kind of plan we want to use for them. And all the contributions that go into the retirement plan are an ordinary business expense, deductible to the business, regardless of the form of business. Doesn't make a difference, and again, whether it's a C Corp or a sole proprietorship, the contributions to the plan are a deductible business expense. The administrative costs, my administrative costs, are deductible, fully deductible business expense to the employer. Again, whether it's a sole proprietorship or whether it's a C Corp or S Corp or anything else. So my hope is that you would begin to get some information about retirement plans. You'd start to think about what type of retirement plan best suits your needs. If you're a 30-year-old, you're going to be looking for a different type of retirement plan, perhaps, than if you're a 50-year-old. And so we would try to get you some information as you start to think about that.